Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set that agenda. Global risk reassessed as U.S. stocks post the worst Fed day since 2001. Markets are jolted with a post-hawkish Fed and a cautious BOJ setting the tone for 2025. Not so fast. President-elect Trump and Elon Musk oppose the proposed funding bill, increasing the likelihood of a government shutdown. Micron plunges after nearly $1 billion miss on the revenue forecast due to sluggish demand for smartphones and PCs. Good morning. As I say in the headlines, it was the worst day for U.S. equities on a Fed day since 2001. Now, we've settled our nerves a little bit, but there was a wholesale ransacking of risk yesterday. SPOOs were down by 3%, the Nasdaq down 3.6%, and the Russell was crushed by over 5%. The killer blow, Julian Emmanuel said, came on the question, can you rule out a rate hike in 2025? You don't rule anything completely out or in. And what started as a market pullback turned into a violent volatility event. To the bond market, this is where the depth charge was really set off. 10's up by 11 basis points, 2's up by 11 basis points, as the Fed skewered the dots from 4 cuts to 2. I would say the bears were reawakened yesterday, but the vigilantes are still in hiding. It was a close call for this cut. That is the most interesting line of it all. It was a close call, and there was dissent. Bonds firm at 452. Stocks we're keeping an eye on for you this Thursday morning. Micron missed its revenue forecast by almost $1 billion. That's as a result of lackluster demand from the makers of phones and PCs. We'll discuss that later this hour. MicroStrategy is rising as the CEO, Michael Saylor, plans to focus on fixed income securities to raise the capital that he wants for buying Bitcoin. And Tesla rebounds after being down as much as 10%, its biggest drop since October the 11th. It was a brutal day for Tesla. And in just a few moments, we'll begin the conversation with RBC's Mark Dowding. Adam Posen of the Peterson Institute for International Economics join me to discuss post-Fed and post-BOJ, pre-BOE analysis. A lot to play for. President-elect Trump hit the tariff plan. It continues to have traders worried about inflation. Chair Powell discussed just how much of an effect it might actually have.
There are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion.
Warning signs from Chair Powell. Well, Mark Dowding is the CIO, the Senior Portfolio Manager over at RBC, weighing in on the decision. Wise men follow new lights in the night sky. Welcome to Christmas in 2024. Mark, good morning. I know that's the title of your piece. I would say that the bears had a field day yesterday. There's a number of elements that were juxtaposed in this speech by Powell yesterday, but I'm drawn to your line, the new light. The new light that is the guiding path, I presume, is the orchestra playing at Mar-a-Lago, which is the tune of tariffs.
Well, I guess you'd probably make that point, but I would say that in giving this a bit of a Christmas theme, I wouldn't be declaring Trump the saviour or anything of that particular nature. But certainly it does seem like something momentous is going on, something different is going on. We're seeing a new narrative here. And I think we're going into 2025 with a lot of uncertainty ahead of us, aren't we? It's uncertainty in the economy, uncertainty in politics and in geopolitics. It really does feel like interesting times that we're living through right now.
So momentous in terms of the trajectory for rates. There's a building coalition of the pause, but I just wonder to what extent do we now, how low is the bar to a hike in 2025, given everything that you listened to yesterday in that Powell conference?
Yeah, so when it comes to looking at rates next year, I mean, for the time being, we're pretty confident that rates are going to be on hold in the first half of the year. Any easing is obviously going to be predicated on much weaker data. But when it comes to the question about what we would need to see in order for the Fed to be hiking next year, here I'd really be focused on inflation. I reckon if you end up with core PCE, which is currently at 2.7, up at 3.5% and looking like it's on a rising trajectory, at that point the Fed won't have any option election. It'll be obliged to raise rates at that particular juncture. We've seen how the American society rejected or was very upset about higher inflation in this year's election. The Fed took its eye off the ball in terms of inflation in 2021. It can't afford to do so again. So if you do see that sort of inflation pressure build to the upside, then I think that's really representing the Fed's pain threshold in the course of the months ahead.
And it's interesting, they raised their PCE projection to 2.5%, and that is without knowing anything of the detail of tariffs. I used the word ransacking of risk, and there was. I mean, it was virulent in the S&P, the Russell down by 5% at one junction. The bond market, I would say, was irked, but the vigilantes are still in hiding. Are we done with this right?
Well, I think in the near term, let's wait and see. I wouldn't like to sort of really give an answer to today's price action, but I would say that risk premia had been very much compressed in credit markets, in equity markets over the course of the recent weeks in the period post the election. And in many respects, we've ended up in a situation in the last month or two where everyone has wanted to cheer on stronger growth and the positives about the Trump agenda. But obviously, the flip side to that is if we're in a world where rates are staying high for longer, then this is clearly more problematic for long duration assets. And you have to remember all the while that equities are long duration assets. These cash flows, particularly on high multiple stocks, they represent long duration assets. And so if we're seeing a move up in longer dated yields, as we're seeing at the long end of the Treasury market, then that does have an influence for the rest of the risk complex.
OK, look, one thing which the market was caught offside about was Japan. Ueda prevaricating he wants to wait until the spring before he has the evidence on wages to go with a hike. Are we entering some kind of a policy era with Ueda prevaricating so much?
Look, I think there is a building risk of this, actually. I think that it's been interesting listening to the Bank of Japan over recent months and really articulating the fact that they're expecting to normalise policy if data evolves as they have been looking for. And in fact, the data is moving in that direction. We're seeing stronger inflation. We're seeing evidence of rising wages. In fact, tonight we'll get some more inflation data in Japan, which should show another jump. And so from that point of view, with data doing its thing, the question is, why is the BOJ not sort of delivering on its commitment to actually normalise policy at a time when real interest rates are super accommodative? And I think here what we might be seeing is actually some political interference coming into play, given the fact that we've got a very sort of weak government in terms of the LDP in minority, wanting to get some support maybe from the DP in order to shore up a bit of a working majority. So there may be political factors, but I was very surprised that Ueda at his press conference didn't seem to firm up expectations for a January move. That's what we would have thought, and so I think that the January meeting now is going to be pivotal for the BOJ. It's about 50% priced. A lot will be riding on that January meeting. And
that takes us through then to these swoons in yen, these bids in dollar. For you, I presume, is an opportunity to sort of look at the crosses. I know that you want to be long yen. Do I look through today's verbiage from Ueda and say, look, I do want to be long yen. I want to be long it on the crosses?
Yeah, look, the yen is a fundamentally very cheap currency, right? And I mean, if you want to do your Christmas shopping, if you're doing your Christmas shopping this year, you could do it in Japan and save about 30% off your price of everything. It was really quite striking how price levels are really kind of somewhat out of whack in many regards. And so from that perspective, you want to be buying the yen. You can see interest rate differentials narrowing and converging over the course of the months ahead. And so in many respects, you think that 2025 should be the year of the yen, but it does depend on the BOJ delivering on rates and, as you mentioned, not delivering too much of a dovish tilt to policy as they did at points last year. So we do think that the yen can do well, and we particularly like the idea of owning the yen relative to the euro. We still think for the time being that we're in a strong dollar environment. In the short term, we think this sort of Trump agenda favours the dollar. But structurally owning the yen against the euro, in our eyes, is really quite a compelling trade for 2025.
Can't let you go. Danny's not here, but I know that she'd ask you this about Chelsea winning 2 trophies. Really? But your political scouts, very quickly, tell me Number 8 on your big calls for 2025, the political scalps that will go, and some of them that are first buddies.
So I reckon Trudeau is obviously gone in the course of the next couple of months in Canada. Poilievre looks like he's going to win the election when that gets called. That seems to be a slam dunk with the Liberals or the Conservatives 20 points ahead in the polls. I also think that Elon Musk isn't going to last in the administration under Trump either. I think the king of Doge is going to get bored, he's going to get frustrated. I can see how the love affair could easily cool. So I reckon he's gone late summer to focus on SpaceX or something a bit more interesting. And I would also say that at the moment, the way things are moving in the UK, I reckon Rachel Reeves sadly will be gone this time next year. I think the Labour government is in a difficult situation. We're seeing UK yields climbing higher and higher. We're in a situation where the Bank of England today, I can't see them cutting rates at all. The bank would like to cut rates, but the honest truth is that inflation is too high, and as yields rise, this is feeding back into the fiscal problems that we're seeing in the UK. And from that point of view, we're quite worried that actually if you do sort of bust through the previous highs in yields that we've recorded in gilts in the trust tantrum, you're going to be in a situation where Reeves is obliged to deliver tax rises.
That's some pretty big scalps to go, but I'll remind Danny that you're still there for Chelsea with two titles for next year, 2 trophies for next year. Mark, thank you so much for being with me. That's RBC's Mark Dowding on reaction to the Fed and BOJ. There are other stories, and they're trending on your Bloomberg terminal. They look like this. Volkswagen Labour leaders are moving closer to a deal to restructure without shuttering the factories in Germany. The agreement would involve workers giving up bonus payments in exchange for job security until 2030 and the implementation of cost-cutting measures. LVMH has acquired a historic villa in Cannes, in France, for around $52.7 million to showcase the brands during the city's star-studded festivals. It will use the 12-bedroom property to host exclusive shows and events for its companies, which include Louis Vuitton. The company plans to rent out the villa during the summer months when the tourists flock to the French Riviera. Maybe it'll be on posh go. You never know. Barclays is set to increase its annual bonuses by as much as 20%. Its investment bank after an improved year for traders and advisory teams. That's according to Bloomberg reporting. Staff in the trading unit are expected to see a 5 to 10% rise in their annual awards, while bankers in debt and equity capital markets could see their bonuses jump by 10 to 20%. Bifurcation in bonuses. Coming up on the show, Trump and Vance don't want a stopgap funding bill. They want a debate. More on the story next on Bloomberg. Let's get you up to speed with the front pages now from around the world. We kick it off with the Washington Post. The CDC confirms first severe human case of bird flu in the United States. A patient was hospitalized in Louisiana after being in contact with a sick and dead bird. The outbreak caused California to declare a state of emergency. Next up, the Wall Street Journal. Russia withdraws its air defense systems from Syria to Libya, according to reports from the US and Libyan officials. Moscow had operated naval and air bases in the country for years to project power in the Middle East and Africa. And finally, you can read it on Bloomberg. Today, it is the Bank of England decision. The BOE widely expected to leave rates on hold. A lot of focus will be on Governor Andrew Bailey and his colleagues' tone, choice of words, as they guide ahead. Pretty much as we were obsessed yesterday by Powell and Ueda, now it is Bailey's turn. Let's get to Dan Hansen, Chief UK Economist over at Bloomberg Economics. Dan, good day to you. So the Bank of England, we assume, will be on hold. What is it that restrains Bailey so much? What is it in the inflation narrative? I mean, we're talking about the risk of inflation, nay, stagflation in the UK.
Yeah, that's right. I mean, what we've had this week, we've had a lot of data out, and we've had two bits of information. One is that wage growth picked up quite a bit more than everyone expected, including the Bank of England, and we've had a re-acceleration in inflation. You've got those two sort of hawkish, if you like, bits of data information, and you set that alongside the Bank of England's sort of prior view that interest rates should be cut gradually. And you get yourself to a world where today it's very, very unlikely they will do anything. All of the focus is going to be about what comes next. And I think the question we're asking really is, we've had a big sell-off in financial markets. We've got only 50 basis points of cuts priced for next year. That's down from 75 at the beginning of this week. And the question is, is the bank going to push back against that? Bailey has been saying that about 100 basis points might be consistent with a gradualist approach. So there is clearly this tension between where the market is and where the bank is. And the question today, I guess, is whether the bank moves towards that, the market, or it pushes back against the market.
Well, this is what we saw with the Fed yesterday, isn't it? The Fed moved from 4 to 2. In other words, the Fed came towards the market pricing. Yes. And the question that goes through my mind when you look at this is to whether, we've got what traders see 50% chance of a cut in February. It's just, is that just too hawkish given the growth narrative in the UK?
It feels that way to me. And I think the other thing you have to remember is where we're starting from, which is a level of interest rates that is definitely bearing down on the economy, definitely bearing down on the labour market, and we've seen signs of labour market weakness and also, as you say, a weak economy. So you're starting from a level of restrictive rates, and you need to bring rates down to a more neutral level, and we think that even the top end estimate of that range for the UK might be 4%. So you're still 75 basis points away from that as things stand. We think it's probably a little bit lower than 4. So that gets you to a world which is similar to what the Bank of England is saying, which is about 100 basis points of cuts for the coming year.
OK, Dan, thank you very much. Let's see what Andrew Bailey has to say to the market and whether he takes a leaf out of Jay Powell's book in terms of the guidance. Chief UK economist there for Bloomberg Economics, Adam Posen, joins me next from the Peterson Institute. From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Cranny. Let's set that agenda. Global risk reassessed as US stocks post their worst Fed day since 2001. Jolted by a hawkish Fed and now a cautious BOJ. Not so fast. President-elect Trump and Elon Musk opposed the proposed funding bill, increasing the likelihood of a government shutdown. Micron plunges as nearly $1 billion miss on the revenue forecast due to sluggish demand for smartphones and PCs. Good morning. Context for you. We have a small bounce back by 0.5% on the Nasdaq. It was crushed yesterday by 3%. There was a ransacking of risk. What you saw was $1.6 trillion of equity market value wiped out. It was your opportunity, some would say, to buy the dip. The Russell was crushed by 5%. The killer blow, according to Julian Emmanuel at Evercore, was, can you rule out a rate hike in 2025? We don't roll anything completely in or completely out. And that was the moment that really the market swooned. Roll it over, have a look at the bond market. I would say that a depth charge went off in the bond market yesterday. You broke through 450 on the 10s. The bears were rewarded. The vigilantes are still in abeyance. This was a close call to actually cut by 25 basis points with dissent. That was the line from Jay Powell. So right now, we're treading water at 452, but we're in a new paradigm, perhaps even a new phase of bond rates. Fed officials capped 2024, as I say, with a third straight interest rate cut and a strong signal that inflation concerns, they're back. Chair Powell discussed the central bank's path forward.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
What could blow them off track to cut? Adam Posen usually has the answers to that. Adam, good to see you from the Peterson Institute, International Economics. Look, you've been bang on the money, Adam. Every time you've been with Danny and I, you've said they won't make the cuts that they promised this year, and you fear that we will be hiking next year. Given what you heard yesterday, and there are many juxtapositions in that presentation, do you think we're closer to a significant pause, or even the hikes, the potential for hikes is even more real now?
I think, thanks, Manus, and I appreciate the call out. I mean, for 6 months, I've been talking with you about this, more than 6 months, this likelihood. I think we are about to come to a significant pause. They may get in one more cut come February, March, but by then they start worrying about the budget, about tariffs, about migration issues, all of which they could have seen coming. More importantly, the underlying strength of the US economy, which they got wrong as recently as the September forecast, again, was pretty evident for all to see. So they have a choice. They can either ratify that and say productivity growth is up in some sustained way, in which case they have to keep moving up the 10-year dot, or they can say this is a blip, in which case they have to explain why it's going to slow down. Right now, they're not doing either. So the markets are correctly pricing in a wide range of outcomes. In the end, I think they'll be hiking by June.
Hiking by June. Let's just square away very briefly. Do you think we are in a growth paradigm shift of productivity before we move on?
Yes, I think it's worth gambling on. And that would be the one good argument that the Fed could make for being in a more cutting mode, is saying we're getting a given amount of growth higher for a given amount of inflation. We're getting readings on productivity that are, of course, variable, but on average are up. But then they have to explain why. And if they want to say AI, again, that's arguable, but they have to make a call. And they so far have been unwilling to make a call.
Well, there was a productivity growth in the 90s, and you will know the precision better than I, but it was a nearly 3% uplift in productivity growth in the early 90s. Forgive me for not having the precise number. They are thinking about tariffs, Adam. Some are already thinking about tariffs. Highly conditional estimates. That was the words from Powell. So there are those on the Fed who are listening to the background music, as I'm calling it, from the ballroom at Mar-a-Lago. But should they be much more forward-thinking in their models on what that will do to PCE, sir?
I think they got to be thinking, Manus. I like the ballroom image because they're dancing while the world is in a mess. I think they've got to be thinking about two issues. The first is, do they consider tariffs inflationary, or do they consider tariffs a one-off price shock? And if it's a one-off price shock, then they say, well, the right response is not to react until we see the second round of inflation. But in the context we're in, with inflation above target, they haven't raised the target. It's stayed there for a long time. The risks are upside. I'm not sure they can do that. But that's the first choice. And then the second choice is the more calibration of rough order of magnitude. How much inflation do you think you're going to get? And if the Trump administration goes ahead with the tariffs, they'll insist, well, you're going to have the dollar go up, and that will at least partially offset the inflation. And last time, we didn't have so much inflation. So there will be a debate, and there will be political pressure for them not to overreact to the tariffs. I think they should treat it as an inflationary shock given the context, and accept that this level of tariff uncertainty is higher than last time. The other thing, though, Manus, which you and I spoke about when I was on last month kindly, was the issue of migration. And again, that's a pure negative supply shock. Now, they could ease into that if the migration flow is cut or if there's mass deportations. But it's definitely inflationary if that happens.
But then it becomes a debate of whether the migration, and we'll know more about the policy, whether the migration supersedes as everybody's saying to me, the tactical deployment of tariffs. Exactly. But when I look at the narrative that's levied against Mexico and Canada, and I look at his rhetoric around tariffs, do you think this time around it will be tactical tariffs or something more enduring?
I think there's going to be enduring changes to the Mexico and Canada economic relationships. The tariffs may not be the end unto themselves, and in some ways I hope they're not. But I think there are going to be changes to make Mexican exports into the U.S. less competitive, to deter Chinese and other investment into Mexico, to raise the rules of origin requirement, to put more burdens on Mexico. And whether that's tariffs or other restraints, it's going to erode Mexican competitiveness. One of the things I did not call right, and I've been surprised by, is the extent to which Mexican markets are up this year, in the context where they have so many issues and where the U.S. relationship is likely to get more fraught. Canada is definitely up for negotiation and should be seen that way. So I think we have to separate the China and the Mexico tariffs from everything else that's going on the tariff front.
I want to get to the Bank of Japan, Adam, because the market, the yen selling off, people are now, Ueda has not verbalized what the market was wanting to hear, which was a hike in January. To the extent that this puts him in conflict with the diet, we can debate. But when you look at Japan and you look at the Bank of Japan, are we now firmly in the error zone in regards to guidance?
I think this is the first misstep in a while. I think they've played it carefully up till here, which was fine. But they set things up, and the economic data was clearly on a path for a hike. Given the exchange rate situation, there shouldn't be any hesitation from the Ministry of Finance of the Diet on this basis. The economy has proven rather resilient in a good way, which is great. So it's hard to see. Obviously, there's a great deal of uncertainty and weakness around the elected government, as in so many places right now. But it is hard to see why right now they're slowing down the guidance in Japan.
I find it interesting that you talk about Japan, despite Nippon Steel being blocked, will benefit from, as you say, Fortress America. Just give me some context around that.
Yeah, I mean, the Nippon Steel is a big deal. It's a negative signal for Japanese and other allied investors in the U.S. But if we think about Trump's goal as creating a wall of tariffs and other restrictions around the U.S., forcing production for the U.S. market into the U.S., investment from abroad, Japan and a few other countries are positioned to benefit from that. They're clearly allied with the U.S. in a national security sense. As a result, they're willing to give up some of their relationship economically with China to stay on the inside of the U.S., and then they can ideally grow with the U.S. as the U.S. proceeds. And so, unfortunately, it looks like Trump is going to be still holding out things like Nippon Steel from that kind of relationship. But Japan potentially and this was Nippon Steel's idea, was that they would get inside the U.S. market. The U.S. Steel was just to be a foothold in the U.S. market, and then they would grow with the U.S. And so I still think that's the direction of travel for Japan, possibly UK, possibly Australia and Canada, possibly Korea. But it relies on both the national security relationship and the U.S. being willing to accept investment from close allies and democracies as though it is investment from the U.S. And they should.
This is the point that you make, Adam, and if we can just square this away, we're nearly out of time, which is the roadmap to de-escalation of tariffs is not to get on a plane, as Justin Trudeau did in the initial point, but it is about FDI into the United States of America. You saw it from SoftBank. So is that the soft power lever to de-escalate tariff aggression from the United States, Trump too?
I think the short answer is yes. That's what worked in the 80s with Toyota, Honda, and others, Kikkoman, all kinds of Japanese companies investing in the U.S. In an allied relationship, that'll work. When you're dealing with China or India or countries with whom Trump has more friction, the U.S. has more friction, that FDI acceptance isn't as clear, so you don't have that avenue out.
Okay, succinctly put. Adam, thank you so much for joining me this morning. That's Adam Posen of the Peterson Institute for International Economics. Coming up on the show, Washington is about to run out of federal funding. You got it. We're looking at a shutdown, and President-elect has complicated the matter. We'll bring you the latest on politics next on Bloomberg. It's Bloomberg Brief. I'm Menace Cranny in New York. Some headlines coming through from President Putin. He is talking, this is his one of his annual address where he takes questions from open mic, as you can see there. But what he has said, if I meet Trump, surely we will have things to discuss. He is ready to meet with Donald Trump. So these are just a couple of the lines. I haven't spoken to him in over 4 years. This is Putin said at his annual news conference. And as of today, there's been no contact with Trump team on the envoy visit. So that's according to IFX. Always an interesting marathon of conversation with President Putin there. OK, time is running out in Washington to renew its federal funding. and the President-elect Donald Trump has come out in opposition of the proposed stopgap. In a joint statement with his running mate, J.D. Vance, Trump said this: "Increasing the debt ceiling is not great, but we'd rather do it on Biden's watch. If Democrats won't cooperate on the debt ceiling now, well, what makes anyone think that they would do it in June during our administration?" So let's have that debate now. Mike Shepard is with me around the desk. Shep, good to see you this morning.
Good to see you.
So not only 24 hours ago was it Elon Musk who torched this continuing resolution, Trump jumped on, and then Trump said, "I want the debt ceiling raised as well." It takes months to negotiate the debt ceiling. So is this a lever to negotiate or a real ask?
I think this is a real ask. As you look at this from Donald Trump's perspective, you're thinking ahead to the first 100 days of your term. And what you want is to have the lane cleared. You want to be able to work right away on that border legislation. You want to be able to get right away to other things like tax cuts that he has promised voters across the country. People are expecting action. They want to see change. And if he has to deal with the debt limit, that will be an exhausting and time-consuming process. As we remember the way it was back in June 2023, we came within a few days of historic default, and that was after months of negotiation. Now, this spending bill that we're talking about, that too has been the subject of weeks, if not months, of negotiation, and we've seen a lot of provisions added to this bill just to try to get enough support for it. That includes disaster relief, it includes aid for farmers, it even has policy provisions like restrictions on outbound investment by U.S. firms in China. Now, all those things would go out the window if Trump gets his way. He wants a clean bill plus this debt limit increase.
As he said, he wants a streamlined bill. He wants to keep the aid for farmers, for natural disaster, but he wants to jettison everything that the Democrats want. He has threatened his Congress. He basically said any representative out there who doesn't vote to raise the debt ceiling is stupid and should and will be primaried. Now, this raises a much bigger issue about how you govern. You have the three, you have the three-line, the presidency, you have the Senate, and you have the Congress next year. But this is a billionaire who's torching policy in Elon Musk, and you have the president really warning, I'm going to rule by a wrought iron. There's no carrot in this, is there? It's all stick.
There really isn't a carrot in this for anybody in Congress when they're dealing with Donald Trump on this issue. He is exercising what we see as raw power in his position as really the de facto head of the Republican Party. And he is able to do this thanks to the support of Elon Musk, who helped bankroll his campaign, but also a lot of other Senate campaigns and congressional campaigns as well. So we're seeing that clout being put to use. Now, the question is, how much do lawmakers actually heed this? Remember,
I would say, how long will lawmakers put up with this?
Well, great question. And we're going to find out within the next 48 hours whether they're able to very quickly renegotiate this whole thing and then try to get it done on time. They have a midnight Friday deadline to finish. Otherwise, a partial shutdown commences on Saturday morning. So this is high stakes. There is no time left. There was a lawmaker interviewed last night from Capitol Hill who aired on another network who said, gee, I wish that the President-elect had made this request a few weeks ago so that we could have factored it into the negotiation. But in a way, Trump, with this brinkmanship, is really putting the heat on Congress.
But this is classic Trump brinkmanship. It's the way of 2025. Let's just square it up very, very quickly. You've got Vivek Ramaswamy and you have Elon Musk hiring for the Department of Doge. What do we know about that so far?
Yes, we had a great scoop last night looking into this and turning up that they have already hired about 10 people to work on this initiative with the hope of trying to cut government spending radically. They have a vision through this Department of Government Efficiency. It's important to note that it is not a government, it is not an agency, and the exact makeup of it for the coming year is still unclear. We don't know if it will be a federal entity or a private, maybe a 501(c)(3). But interesting that Elon Musk has tapped a couple of people from his universe, from Boring Co. He has an executive from there who's helping lead the hiring effort. And we also have the former U.S. Chief Technology Officer, Michael Kratsios, who was in the Trump administration, is now working with Elon Musk on this effort. So it's coming together quickly. We don't know exactly who's paying the salaries. They do have office space for now in the SpaceX building, not too far from the White House. So they will have access to the halls of power. And certainly, as we see from yesterday's events, Donald Trump's ear.
Okay, Shep, thank you so much. That's Michael Shepard there with the very latest on the political stories from Washington. And don't miss our interview with the Secretary of State, Antony Blinken. That's at 8:15 a.m. Eastern, 1:15 p.m. in London. Earnings, yes, there still are earnings, and it's from the tech side. Look at this, Micron Technology plunging in the pre-market. This is the largest U.S. maker of computer memory chips, posting disappointing revenue forecast by sluggish demand for smartphones, personal computers, everything that we use. Jake Silverman is a semiconductor analyst for Bloomberg Intelligence, joins me around the desk. Wow, I mean, that is a brutal reaction. Just how far off the estimates was Micron? What injured them?
Yeah, it was about 12% off their guidance, or their guidance was 12% off consensus estimates on sales. So, yeah, it really is. It comes down to an inventory correction, maybe temporary in PCs and smartphones, and it was really a result of customers building up inventory over the last several quarters ahead of anticipated price increases, and now that's starting to have an impact.
Just looking at what some of the analysts are putting out this morning, Morgan Stanley, they've got an equal weight on it. They say the decline was due to NAND flash memory chips. What does that tell me about the state of end demand out there?
Yeah, so there's a little bit of a difference between NAND and DRAM. Right now, what's happening with DRAM is that they're getting a lot of demand specifically for AI-related products. You can think about high bandwidth memory, high-capacity DIMMs or DRAM modules. And there was an AI story in NAND as well with enterprise solid-state drives, but even that seems to be moderating in the meantime. So there's definitely a little bit of a dichotomy.
So look, you had the Broadcom phenomenal performance last week, at one stage over 2 days, up 38%. So you had this massive move with Broadcom. NVIDIA was giving a little bit back. Is there a shifting landscape in terms of the demand for AI products and chips and who's delivering them?
Yeah, look, so I mean, Micron supplies, for their high bandwidth memory, they supply into NVIDIA's GPUs as well as ASICs, where Broadcom is more influential. So, you know, when it comes to AI, really, Micron is a little bit more agnostic in terms of who's actually benefiting from them in terms of the compute processor. And then when we think about other areas like high-capacity DRAM modules and LP5, which is other products that they serve into AI, again, they're pretty agnostic. As long as there's demand for AI infrastructure, they'll benefit from that.
Jake, thank you so much. Context there from Jake Silverman on Micron. The stock really under pressure this morning. Coming up, a slew of economic data, plus the interview with the Secretary of State, Antony Blinken. That is an interview you do not want to miss, right here on Bloomberg. Quick look at what's ahead for the rest of your day. The Bank of England will announce their rate decision at 7 a.m. Eastern. Secretary of State Antony Blinken speaks to Bloomberg's David Gura. That is at 8:15 a.m. You don't want to miss that conversation. And we have a slew of economic data then. Core PCE, GDP, personal consumption, and the jobless claims, all at 8:30 a.m. Undoubtedly, one market, I mean, risk premia was blown apart yesterday, really on the back of that hawkish cut from the Fed. But the yen bears are having a party. Look at this. The past 4 days, I can tell you, there's a sell-off in the yen. We've just had a conversation with Mark Dowding. Very definitely we're at the start, potentially, of policy error, as Ueda basically said, I need to wait until the spring and watch momentum before he makes up his mind on what happens with rates in Japan. Yen under pressure. Good morning from Bloomberg.